When you click buy or sell on an option, what actually happens behind the scenes? Who's on the other side, and how do they manage the risk? In this video, we're pulling back the curtain on the options market, from how market makers quote prices to how they hedge risk, and ultimately, how your orders get filled. Who are market makers? First, let's define the players. Market makers are professional trading firms whose job is to continuously post both buy and sell prices for options contracts. Their goal isn't to bet on the market, it's to profit from the spread between bid and ask while providing liquidity to traders like you. They use sophisticated algorithms and models to instantly quote thousands of strikes and expirations across hundreds of stocks. How makers quote prices. So how do they decide what prices to show? They start with models, like Black-Scholes or more advanced volatility-based models, to calculate a fair value for each option. Then they add adjustments for volatility skew, order flow, and risk limits. The result? A constantly updating two-sided market, a bid to buy and an ask to sell. This means when you look at an option chain, you're really seeing the market maker's best estimates of fair value, adjusted to protect them from risk. How they hedge their risk. Here's the important part. Every time a market maker fills your order, they instantly take on risk. If you buy a call, they're selling it, meaning they're now short delta. To neutralize, they often hedge immediately in the underlying stock or with other options. This is called delta hedging, adjusting exposure so they don't get blown out by price swings. But that's not all. They also manage gamma, vega, and theta across their entire book. It's like juggling a dozen balls at once, with risk constantly shifting as markets move. How orders get filled. So what happens when you hit that buy or sell button? Your broker routes the order, or sometimes directly to a market maker through payment for order flow agreements. The market maker fills your trade at or near the quoted bid-ask, depending on whether you're buying or selling. Behind the scenes, they instantly update their models and place hedges to keep risk balanced. This all happens in fractions of a second. For you, it feels seamless, but under the hood, it's a complex ecosystem of quotes, algorithms, and hedges. Why it matters for traders. Understanding this process can make you a smarter trader. You'll see why liquidity and bid-ask spreads matter so much. You'll understand why large or complex orders can slip in price. And you'll know that market makers aren't out to trick you. They're just managing risk while providing the quotes you rely on. In short, when you trade options, you're really interacting with one of the most advanced trading machines in the world. To recap, market makers post two-sided quotes using models and volatility curves. They hedge risk immediately, often with stock, to stay neutral. Your orders are filled in milliseconds through a broker-to-market maker pipeline. It's the hidden machinery that makes options trading possible. Thanks for joining us. If you found this peek behind the curtain helpful, hit like, subscribe for more trading breakdowns, and drop a comment. What part of the market-making process surprised you most?